Hi, guys. Welcome to the How I Raised It podcast, the show where we get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Matt Burris of Venture Studio Associates, a firm that helps people design and build their venture studio or startup studio. This episode is, as you can probably guess, all about venture studios. We talk about the two types of venture studios, how to evaluate a venture studio if you are a founder, what venture studios are looking for in entrepreneurs, several examples of successful studios, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or Fundingstack.com if you are a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Matt.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite and Fundingstack.com. Today I have Matt Burris of Venture Studio Associates coming to us from Atlanta. How's your day going?
Pretty good so far.
Great. I'm in San Francisco. It's nice weather out here, getting into the nice fall season. And it's the best time of year in San Francisco is kind of September. We get our real summer and the weather's like perfect and lots of fun activities. So all the tech events, TechCrunch happens, and Blue Angels come into town, and of course, all the other fun stuff of the fall football season. So it's a good time to be out here. Yeah,
it's been a while since I lived out there for a few years, so brings back good memories.
Yeah, awesome. Well, cool. Thanks for doing this. What is Venture Studio Associates? Let's start with that.
Yeah, so we help people design, build, launch, and grow their venture studios. So the vast majority of our clients are exited founders, from 50 million to over $1 billion. And we customize the studio that they want to build and make sure that, their vision of that studio is really embedded as a core element of how they're going to go about helping people build companies.
Cool. So this episode is a little different than most in that it's going to be just a super deep dive into all things venture studio. You are my chosen representative expert on venture studios. Let's just start off with a super basic one. What the heck is a venture studio?
So I look at a venture studio it's just a company that builds other companies. It does it though by playing three core roles. It plays an entrepreneurial role, an operator role, and an investor role. And so it gets their hands dirty, getting in there, building, guiding, and providing the financing to build a company. I was just talking with the guys at Nobody Studios in one of the ways that we reframe a studio so more folks have I'd say a better understanding of what a studio really does is imagine an ops-heavy private equity fund that starts companies. Mm-hmm. Mm-hmm. So you've got a big team that gets their hands dirty, building the company, putting playbooks in place, hiring people, building the product. And you've got, the finance approach where, the whole private equity playbook is really how do we de-risk growing this company? So that's really embedded in the process of a studio itself. But we're breaking the private equity model because we're building companies from scratch. We're not necessarily acquiring it, although that is something we do see studios do as well.
Okay. So I guess kind of some basic questions. I don't know that much, so forgive if any of these questions are too basic. But in most venture studios are coming up with the idea and hatching it, right? Or are they sourcing the original idea of the companies they are creating? Is that a defining feature of venture studios?
I wouldn't say it's defining because there's lots of ways they can do it. So one of the ways that I look at it is what founder role are you going to play as the studio? You can be the founder. So you find the idea, you validate it, and then you bring in an entrepreneur or hire a CEO. If you've built this company out far enough, you're past 0 to 1. You could potentially bring in a CEO. It looks more like a private equity play. But the studio could also be the co-founder. So the partner at or around the idea stage. You could be the late co-founder where the studio is joining an existing startup that has some amount of validation around their product, but they're playing a co-founder role in joining that company, or they can be the refounder. This is where you're licensing IP or acquiring a company to use as a foundation to build from.
Okay, interesting. What's the most common model? I mean, I'm familiar with.
I would say it's a combination of founder and co-founder. A lot of studios will start as the founder because often you have entrepreneurs that started the studio and they're like, love finding ideas, love that 0 to 1 stage. But one of the challenges with that model is you now have to find somebody that is the perfect fit for your validated opportunity. And so the pool of ideal candidates has shrunk to such a small amount that it's really hard. And so a lot of studios have found that is such a challenge that it's much better to try to find co-founders. So bring that founder in as early in the process, which has a couple of really amazing benefits, because that founder now has the ability to influence that opportunity. They fall in love with it because they're doing the customer discovery and seeing it firsthand. And because they're shaping how that opportunity is developing, they also take ownership that way. And so it tends to make a much stronger founder and opportunity match when you do it that way.
Okay, let me get into the weeds a little bit on this. Like, from when I think of venture studios, I think of the principals, the people who started the studio are coming up with the ideas, sort of hatching it, and then finding teams around that. But I guess the other model is I'm an entrepreneur outside of the studio that I have a basic idea, maybe a super early prototype, and I'm coming in to kind of help build it. Is that variation?
Uh-huh. There's an AI focused studio in San Francisco. You might know the name of. They accept outside ideas. So pitch them your idea. They'll run it through their process. So they'll have some experts look at it. They'll do a little sanity check. Do they think the market is big enough to justify building this out as a product and company? And if it looks good, they'll bring you in. Now it's like, okay, 12 weeks. Let's go through this. Let's build this thing. Let's de-risk it. Let's understand what the product really should be, who the customer really is. How do we go build this thing? And if it passes all of the checks that a normal VC would look at, they're going to fund it. And now it's on the venture track. So yeah, you can take an idea to a studio. Not all studios accept outside ideas. So it's very, very studio dependent on how they approach that. Which
okay, that's interesting. What's the name of the accelerator? I mean, I'm assuming
I want to say it's AI Fund.
And okay, but is that a common model, or are most models the ones where the ideas are being hatched from within in the studio?
It's pretty common. Like I said, the founder studios where they're coming up with the idea, and co-founder studios, that probably accounts for 2/3 of studios in the world, if not more. So I'd say between them, it's probably a 50-50 split. But a lot of studios that start as the founder studio, you're not locked into one role. So most studios end up playing more than one founder role. And that co-founder role is so close to the founder role that they often will play that role too. And we see a lot of studios kind of make that evolution because they see how challenging that founder role is. Pioneer Square Labs and High Alpha, for example, both started much more focused on being the founder, finding the idea, validating it, and then bringing in the right person to go build this company. And that was really difficult. So they started opening up and adapting their process to try to get ideal founder candidates in that funnel, in that process as early as possible. And then they get to work with these folks to really shape that company, shape that idea to make sure that it is ideal for how they're going to build companies, follow on capital, and they can make it successful.
Yeah, that's interesting. I mean, I'm kind of thinking, as we all do, I'm thinking of this through my own lens. Like I remember when I had this idea for Foundersuite many years ago, my first step was, I'm going to go find a technical co-founder. I spent some time trying to find a technical co-founder. Didn't get much headway there. So my next step was to go hire an offshore development firm to help me build it. Mm-hmm. I guess the venture studio is almost a third option now for people who have relevant background and a good idea. Is that correct?
Absolutely. And a great way to look at and really evaluate a studio. If you are looking to go join a studio, evaluate them as if they are a co-founder. So evaluate them very harshly. Right? High expectations if they're a co-founder. So the ideal co-founder is probably somebody that knows the industry, has some great connections to get customers and investors aligned with this, has the right skill set that you're lacking. They're bringing a lot of operational and execution capability to what you're trying to go do. And if they can bring some funding so you don't need to, that's fantastic. That's what most studios look like, is they're bringing that level of value to the table day one. And that's one of those unique things, right? We've both been down that entrepreneurial journey. When you first start, it's you, co-founder or two, maybe, and that's it. You don't have a lot of resources because you're not funded yet. And now you're going to struggle for 12, 18 months or more, try to get enough traction to like get that first bit of funding in. And it's really, really difficult. With a studio, the funding is there now. The team is there now. The support is there now. So you get to move so much faster.
Yeah, that makes sense. That's a good pitch. I guess so that's what you're getting. What are you giving up? If I, again, came to a venture studio with my idea, I'm assuming it's a really big chunk of equity.
It's
right?
a really big chunk of equity. Yeah. I mean, you're effectively hiring on a co-founder. So expect a co-founder share of equity. Studios range the gambit, and it's a large range. The one you'll often see quoted is like 10% to 80%. Now, obviously, if you're going down the venture track, 80% does not work, right? Any VC, follow-on investors are going to look at that and say, I'm out. But if you're not building for VC, and instead you're getting, say, debt financing as follow-on, and your exit path is to sell into private equity, then that cap table is just fine. So one thing that I work with studios on a lot is like, how do we define an appropriate cap table deal structure for the companies you're going to build? And one of the big things is look to the follow-on capital that you're going to be delivering these startups to. If they can't say yes, you as a studio have already failed. So
do a quick little scenario.
Understand that piece.
Yeah, what does that look like? I mean, a founder, let's go through a quick use case.
Yeah.
Some guy, some gal has a really clever idea, decides to go down the venture studio path to get that idea into the world faster, better, everything else. Finds an appropriate venture studio that does that type of deal. So, what does that look like? What are they getting? And we talked about a little bit already. Do venture studios provide help in building the product? Is it kind of like a technical co-founder or more of a ops co-founder?
So it depends a little bit on the studio, but a lot of studios do support that. They also will often provide capital. So if it's not something that they have on their team, then they know folks that you can tap into, and they provided you the capital to engage them. So that studio should fill the role of a co-founder. So if it's just you and you're sitting there going, what path do I take? Do you know the right people to come join your team? You're going to give up a big chunk of equity to bring them on board. Do you want to give one of those co-founder pieces of equity to a studio instead? The interesting part, if you play this out over time, if you go down the studio path, the next round you take in is going to be pre-seed or seed often. So you've skipped over your friends and family round, little angel round, no accelerator, and hopefully pre-seed. If you do that, then you might end up with a greater individual ownership than you would have if you went down the normal path. And in part, it's because the studio from day one will enforce a couple of the right cap table and equity decisions. It's put an options pool in day one. So great. If you see a lot of the cap table breakdowns on LinkedIn, they're like, oh, we want founders to have 50% by Series A. If you ever look at those charts, there's no options pool. That's 15, 20% dilution that they conveniently forgot. And that's only going to apply to the founders. So there's a lot of these little pieces that don't show up, but a studio will go, let's do it right, because it protects us. Because the studio is also going to be a common stockholder. The capital they put in might come in on preferred, but that puts them in a very interesting position because they want to make sure that the common stockholders, the other founders, are taken care of as well. Yeah. So, the fact that the studio also brings a team means those early hires aren't happening. You can leverage the studio for that instead. And so you're a little bit more mature and giving up a lot less equity to bring in your first real hires.
Yeah, that's interesting. Now, let's continue with the scenario. The woman in this scenario chooses a Excel studio, gets into it. How much capital are they typically putting in? And does she go into this studio for 6 months, a year, 2 years? What's the sort of duration? I'm probably framing this too much like an accelerator, but still, break me out of that if that's.
Well, I think that's a good way to look at it, because if you look at most accelerators, it's 3 months. It's 50, 100, 150K, typically in that range. Studio is usually going to start at 6 months of support, and you're going to see it's more common around a year to 18 months. Capital can be anywhere from, on the very low end, it's, 100K. It can be well over $1 million as well. So it really depends on the studio. But on top of that, there's often stipend or salary. So unlike most startups, when you're starting, you can actually get paid and at least pay your bills if you're working with a studio as a partner, versus it's all out of your own bank account.
Yeah. Okay, let's flip the same scenario around. The studio is looking for what? Like, what types of founders or entrepreneurs are going to get into this studio? What does it take to get accepted?
Well, every studio out there would love to work with serial exited founders. That's an easy one. But the reality is there's very few of them. They got a lot of options. And while it's their preference, it really depends on the studio's strategy. So Pioneer Square Labs, I think, is an interesting example, because they target 3 very specific founder personas. They're looking for exited founders. They're looking for repeat entrepreneurs that haven't yet had success, but they know what that work is like, right? They're experienced. They've raised some money, but it hasn't resulted in a great return for them yet. But they know what this role is going to be. The other persona they look for are product managers, folks that haven't had any hands-on entrepreneurial experience, but operate very similarly within the corporation. So it's easier for them to step out and kind of take on that role. I've seen studios that target corporate executives and pull them out, put the right support around them. I've seen studios that target recent college grads, and again. But in general, if the studio is playing more of a founder role, they're now trying to play matchmaker between opportunity and founder. So the more experience you have as an entrepreneur, the more experience you have aligned with that industry opportunity, the more likely you are to fit that role.
Yeah, it's interesting. That's really fascinating that their Pioneer Square Labs is looking for experienced founders, but ones that haven't, had the big exit, right? That's a really interesting kind of specific profile, and I totally understand why they're looking for that, right?
There's a lot of data that shows folks that have had lots of that experience, even if they haven't been successful yet, much more likely to be successful in the future, and especially in the studio environment, because the studio is very actively involved in building this company. They can really support that founder, help them grow, identify what the gaps are, and kind of coach them through to really be that much better that next time. So it's all about de-risking, building companies within the studio. And so that's a core strategy for them.
Now, I know it's going to vary, but complete the sentence. Most venture studios are working with or hatching X number of companies per year. What's a typical, kind of model there?
I'd say there's a bifurcation. You've got studios that are building, say, 3 to 5 companies a year. These are generally smaller or just getting started. And you've got studios that are building more than 10. The interesting difference is really around their process when they get down to it. Because if you're only building 3 to 5 a year, you don't have to have a fully developed playbook, a really smooth and well-operating machine to build these companies. If you're building 10 or more a year, you have to have this thing dialed in. And there's a very small data set out there. 500 Global published it. I did a little analysis around it. And the studios that were building 10 or more a year seem to have better returns. I think it's in part because they're forced to figure out how to do this a lot better, a lot more repeatably, without just solving it manually by hiring more people.
Yeah. Okay, bit of a gear change here, but where did this model come from? I feel like venture studios have just sort of come out of the ether in the last few years. Like I know there was like Idea Lab and a few
Mhm.
others like this even back in the 90s, .com boom and stuff. But like, where did this all come from? Give us a quick
Yeah,
history. Yeah.
you got it. Idea Lab was the first modern version of a studio, and Bill Gross down in the LA Pasadena area, he was around a lot of the film studios, saw how film studios were organized. Right, so you bring a lot of the talent that's required to create a media property, film, TV, anything like that, and rather than work on one project, you'd work on a set of projects, a cohort. And so it's really adapting that approach to building companies. And so as you would, do one film project, you learn, how to do things a little bit better. You apply those lessons the next time. Same approach in studios. And I'd say one of the reasons that we haven't really heard about studios very much is studios have really, for the last 25 years, focused on their portfolio companies and not talking about the model itself, which makes sense, right? They're there to build those companies. But it's done the asset class a little bit of a disservice because one of the objections is like, if studios are so great, how come I've never heard of anything built by a studio? And it's like, okay, it's a fair point, right? We have not really made that connection. So Liquid Death, Dollar Shave Club, Unicorns from Science, Moderna Therapeutics, COVID vaccine maker, built from Flagship Pioneering studio in Boston. They focus just on biotech. They've had 7 IPOs, I want to say, built 48 companies. So there's a lot of these success stories, Atomic, Hims and Hers, right? Unicorns have come out of studios, but very rarely are those unicorns associated with studios. Another good example is Snowflake from Sutter Hill Ventures. They built it. They were part of the founding team in launching Snowflake. They were looking at this opportunity in this space for 2 years, trying to figure out, what kind of company are they going to build here? But most people don't associate Snowflake as built by a studio.
Sutter Hill, a
But it's
studio
got that
or
pedigree.
venture fund?
So Sutter Hill Ventures is an evergreen venture fund, but they also act as a studio for some of their portfolio. So in the case of Snowflake, they acted as a studio.
It
One of the
almost feels
partners
like a
was the
little bit.
founding CEO of Snowflake.
Gotcha. Yeah. I mean, I kind of think back to like the 2000. I'm just showing how old I am now, but like kind of the 2000s. I feel like there were a lot of venture funds that had an EIR program, right? Where,
Mhm.
there was a founder, his company or her company was acquired, and then these EIRs, entrepreneurs in residence, would just kind of hang out at the venture office and kind of cook up the next thing, right? And it feels
For
like it's
sure.
all evolution of that, maybe. I don't know. Is it?
There's definitely a link to it. And
Yeah.
you'll see a lot of studios have an EIR program. And the EIR might be there, like your job is, let's go build the next company. Or your job is help us evaluate a lot of these opportunities. And if one's a good fit, we'll transition you over and you run it. But I'd say the really big difference between a VC that has an EIR program and a studio is the VC is primarily playing the role of an investor. They're not an entrepreneur. That's not how they operate typically. They might have that entrepreneurial background, but that is not incredibly common either. And they're definitely not playing an operator role. They're not getting their hands dirty building that company. There are a few venture funds that do have a couple of these things, right? Andreessen Horowitz, they've got a good ops support team that goes in and helps build companies, but they're not playing that entrepreneurial role. So that's one of those distinctions I always pull in. It's like, if you're a studio, you're playing the entrepreneurial role, you're playing the operator role, you're playing the investor role. If you're not playing all three, then you're not a studio.
Yeah. Okay, gotcha. Entrepreneur role. What were those three again? Entrepreneur.
Entrepreneurial role, the operator role, and the investor role.
Oh yeah.
So one of the challenges, we have a phenomenon that we call vulture studios. So this is, be aware of these and run the other direction. These are more, they look a lot more like service providers, but they call themselves studios. So when you were looking for that software development agency to build the first version of your product, a vulture studio might show up and say, hey, we're a studio. We'll build the product for you, but they're not going to play the real entrepreneurial role. And they're just going to take a bigger chunk of equity for the same, service that a normal service provider would have taken. So they're not truly playing that role. They're not your partner. They're not owning. There's no control aspects in building this thing with you. So that's definitely something to be aware of. If you're looking to work with a studio, make sure they're really a studio.
Let's touch on that kind of in a slightly different way. What are the downsides, the negatives? Obviously, giving up equity where you maybe don't need to, right? You're a founder with a good idea and you have some background, so giving up equity is one. What are some of the other negatives or risks of going down the studio path?
I'd say one of the big ones that everybody should be aware of is raising capital after the studio is going to be more difficult. The studio model is still emerging, and the awareness is growing, understanding is lagging. And if I look at venture capital as a follow-on investor to anything a studio builds, I'd say 60% of VCs are a no. They don't like the cap table. They look at studios like, you're an investor. Why are you taking so much equity? I'm rejecting you as a founder. I'm rejecting you as an operator. You're an investor and I'm out. So that exists. That's a challenge you're going to have to overcome as a studio, as a portfolio company.
And that's because the cap table has the studio owning a big chunk, which means the founder is going to, have less motivation to stay around. I mean, is that the biggest?
That's how the VCs will look at it. Where I would go is dig in one level deeper. The individual founder in that portfolio company, from the studio or not studio, what's their ownership level? Because when I do the modeling for this and I account for all the sources of dilution, it's actually not uncommon for the studio founder to own a bigger piece than the non-studio founder. And the reason is I got to skip some funding rounds. The biggest one is I got to skip bringing on an additional co-founder. Single biggest dilutive event for almost any startup out there. Co-founder number one.
Sure.
Yep. If you don't bring on co-founder number one, well, that changes the game a lot. If you can skip hiring two co-founders, partnering with two co-founders, that really changes the game. So if this, ideally a studio must remove the need for one co-founder. If they can remove the need for two, the cap table is now drastically in your favor, as long as they're not, taking an outsized piece. But it is something from the follow-on VC standpoint, like they're not very familiar with it. And that is their red flag, is you're not motivated enough to stick around. But at the individual ownership level, you have more. So you got to dig into that level. What we're seeing play out in industry right now is the VCs that have invested in studio build companies are interested in more studio build companies because the quality is higher. And that translates to a better performing company. So the appetite is growing, but because of the cap table challenge, it's a different approach to building companies. There's definitely a lot of resistance.
It's interesting. Can you think of venture funds that are kind of known, more venture studio friendly? Like, who are some of the venture funds that are open to venture studio hatched startups?
Off the top of my head, no, but I have a list of them. So we can share that with your audience and maybe put it in the comments
Put
to
that
answer
in
that
the
one.
footer or something. That'd be great. Yeah.
But yeah, there's several venture funds. So I pulled together a list of 1,433 VCs and investors that have invested in studio built companies. Those are primarily US based. The list is available for free. I can give you the link where people can download it as well. But I did stack rank the VC firms, and there's 15 or 20 of them that have invested in like 3 or more deals, and that data at this point is 2 years old.
Yeah, that'd be definitely interesting to take a look at. What are some of your favorite? Let me ask this in a quirky way. What are either some of the most successful studios, or what are some of your favorite? And those could be two different, completely separate things.
Yeah. No, I'll share two. Let me highlight NLC Health for a couple reasons. So NLC Health.
Say the name again.
NLC Health.
Uh-huh.
They're a studio in Europe. They got their start not by raising money for the studio, but by raising money for the first portfolio companies they built. In fact, they operated for several years just raising into portfolio companies. Their strategy was to license IP from the EU university ecosystem in the health and medtech space, take it to an investor group that focused on those kinds of companies. And the founders of NLC had built those kinds of companies. So it was like, hey, this is the IP. Here's the opportunity. You guys invest in this. If you invest, we'll build. They started in 2015, I believe. They've built over 150 companies so far. The numbers they had on WeFunder, so you could actually, I don't know, I don't think it's still open anymore, but you could have, invested as an individual, 7x multiple, including all companies from day one, successful and failed. So solid track record. There's another studio I'd like to share with folks to like break the paradigm that this is only about building venture backable companies. That's a studio that was that operated in Atlanta. They shut down 20 years ago. It's run by one person. They built IT consulting companies, professional service firms. So the strategy was partner with an executive, usually a VP of an IT department, pull them out. They've got the network. They've got the experience. They know how to manage people. And say, hey, we'll help you out. We'll provide the capital. You got 18 months runway. Let's go build this. And the guys behind it had built and sold professional service firms. They knew the space very, very well. And they had better than VC level performance for the fund. It was over 25% return annual. And the interesting thing is, because of how they were structured and they were building cash flow companies, got cash back in quicker, because they got to take distributions of profit in addition to exits. And the exit multiples in service businesses were low, 1 to 2x, but worked very, very, very well. So you can use the studio model to build any kind of company you want. It just changes how you do it.
Yeah. Interesting. Okay. Those are definitely interesting. How about, what are the most successful ones? I mean, you mentioned a few here: Science, Atomic, Idea Lab. Was Idea Lab a success?
Oh, for sure.
Yeah.
They've built, I think it's over 150 companies as well. They've had very, very good returns. Flagship Pioneering is probably one of the biggest. They've got a $5 billion fund. It's probably grown since I saw that stat. There's so many studios out there that it's hard to name them all, but I'll throw a few more names out there. You've got High Alpha in Indianapolis. They're a SaaS-based studio, but one of their first portfolio companies in the first cohort was High Alpha Innovation, which is one of the more active corporate venture builders in the US. They build companies for corporations. So the corporation will come to them. We got a problem. Can you build a company to go solve this problem? They'll fund it and go build it. They also now build studios. So it's kind of an interesting meta example. You've got eFounders, which is now known as Hexa in Europe. That's one of the older studios in Europe. I think the original, though, was Rocket Internet. Their strategy was like a fast follow. We'll see what's working in the US. We'll adapt it to the EU and build it here.
Yeah, I remember those guys. They kind of cloned everything, right? Uber.
Oh, yeah.
Yeah.
I mean, it's a great strategy because, if you're the US unicorn in the space, how do you move over to Europe or other markets? It's often easier. Like, let's just go acquire. And that was part of their approach. Sometimes it didn't work out that way. HelloFresh became the more dominant market force, and they were started by Rocket Internet. So, there's so many different approaches a studio can take. You can start from scratch. Flagship Pioneering, we'll come up with an idea. We'll figure out the biotechnology and the pharma technology behind it, and we'll go do it. You can license technology and build a company. You can partner with a founder day one and figure this out together, like a lot of studios do. Atomic,
super interesting.
Hexa, let's see, Juxtapose, I think in New York is a really interesting one. They will spend 1 to 2 years figuring out that opportunity, basically building up the business plan, the product roadmap, identifying the first several hundred customers. And so this is basically like turnkey, let's go build this thing. And they'll bring on a multi-time public company executive to build it. Because now it's not about that discovery and figuring stuff out. It's about the execution. So we need to bring somebody in that knows how to execute really, really well. So basically every studio out there is unique. which
Yeah, very interesting.
it's interesting. And they collaborate a lot because they don't really see each other as direct competitors.
Is it getting crowded? Is it almost too crowded? Are we at peak venture studio?
I'd say no. The interest is exploding. We're going to see a lot more studios come on the scene over the next 5 years. But if you look at the amount of companies any given studio can build, let's go back to Idea Lab. They started in 96. So we're almost 20 years, almost 30 years later from Idea Lab. Give it another couple of years. They built what, 150, 100, we'll round up, 175 companies. It's not a lot. That's a handful a year.
Yeah, right.
So, the pace, like one studio is creating what? Enough companies for 1 to 3 venture funds to invest in. So we've got a long way to go, a lot of capacity to build. Plus, there's a lot more options than just venture for your follow-on capital. One thing I like to say is you have all the options in the world, from no follow-on capital. We're going to build this company in the studio as a cash flow generating machine from day one, or we can go venture capital, unicorns. We can do anything in between. It shapes what you do and how you do it within the studio. But because you have that flexibility, we're going to see a lot of studios show up because it's really a model that de-risks entrepreneurship as a whole. It's custom tailored to de-risking a specific type of entrepreneurship and a specific strategy. But because of that, the ecosystem can support a lot more studios than we really could see, say, accelerators.
Yeah, that makes sense. Yeah. It's interesting. I mean, I'm now, again, putting myself in the shoes like, okay, I've got Foundersuite, but it'd be fun to create the Foundersuite Venture Studio, right? Like, why don't we back entrepreneurs who want to build founder-focused tools? Because we already have the founder customer base. We have 100,000 startups in our customer database, right? So, what else could we pump through to them?
Well, so let me show you a different model. So often when people want to start a studio, the first thought is let's go raise capital. That's really hard to do. It's just like raising for a venture fund. Tough competition. There's other ways, like the NLC approach. Let's go raise for the portfolio company. The other way, this is where I think you could fit in. We're going to go build a service firm, or we have a product that's generating revenue. We can use some of the profit from that to operate the studio. There's a couple studios that have done this. There was one based in, still alive, based in Abu Dhabi. They started probably 12 years ago. $1 million to start, software development focus for the first service provider they built. Today, their portfolio is valued at 110 million. That's 110x return.
What's their model? Repeat that model.
So they started as a software development shop.
Okay.
Then they layered in other service providers, and then would use the profit from that, not all of the profit, but some of the profit, to start companies. They operate as a studio. And several studios have started this way. There's a group called the Paloma Group. They used to be Dovetail in Australia, software product development firm, moved into the studio model, and they found a lot of success. So there's a studio in Germany called the Delta that also takes this approach. They have multiple service providers. They can take some of the revenue from those service providers, put it up at a top-level holding company, fund the studio operation, and when a portfolio company needs to engage one of these service providers, sales and marketing, HR, recruiting, software dev, that top-level holding company can subsidize that engagement. So the service provider sees a full freight paying customer. We're not going to put the C team on it. We're going to give them the best team out there. And it's actually affordable for that portfolio company to use. So there's a lot of complexity you can bake into a studio model, but it gives you a lot of optionality on how you go execute. So if you've got access to customers and you've got a revenue stream, now you can start saying, hey, do we effectively sponsor a founder to go build some of these companies and we participate in them? It's an interesting approach. And we see some corporations going down that approach as well, because it helps solve some of the structural challenges that you have within an operating business to do something new. If you're an operating business, your goal is to keep moving forward.
Yeah.
make this thing stable, operate well. Doing something new, that's just a little bit of a distraction for everybody. And you often don't have the resources to do it, the staff to go do it, because you're focused on mission one, which is keep that company operating well.
Are most or many, I mean, rephrase that, are many venture studios venture backed as well? Or are most of them, building this off of various profit revenue streams?
So I'd say more studios are backed by investors that might not be venture funds. Usually the venture fund is more of a very small LP in the studio, but that's starting to change. So that's one of the trends that's been happening this year is more and more venture funds are interested in partnering with studios because they can get some really, really good deal flow, and they can even go, hey, we've been looking for a company that does this. We haven't seen anything. Can you go build it? And we're going to invest in it. So there's definitely some synergy between a venture fund and a studio. And we're starting to see more of those plays show up.
Yeah, interesting. Very cool. Any other tips if I was going to launch Foundersuite Studios? Like what else should I kind of consider as I'm thinking about this? I like the idea which you kind of already alluded to. Like what's your special advantage, unique advantage, your sauce?
What's your superpower that you're bringing to this? So one of the first things I do when I sit down with any entrepreneur that wants to start a studio is, what do you love doing? A studio is going to be a 20-year plus commitment. If we can't embed what you love doing in this studio, you're going to walk away in a few years because it's not a fit. So, I'd say start by looking at what you love doing. Do you like that 0 to 1? Do you like hopping on the call and talking to potential customers, founders, understanding what we should go build? Do you like playing around with that strategy? Do you like the fundraising piece? Figure out the role that you're going to play within the studio and how you can keep doing that and make it a good touch point for yourself. That's going to shape your studio design a little bit, because if you lose that, you're going to lose the studio.
Love raising the studio loses startups. Is that enough to build a studio on? Like, could the pitch be? And I'm just using this as a scenario, of course, but like, is that a big enough hook for building a studio on? Yeah.
Well, I think I would reposition it a little bit. So one mistake that a lot of studios make when they try to raise is they talk about the studio model. Don't talk about the studio model. You're not a studio yet. That's what you aspire to be. So don't use those numbers. Use your superpower. So if I look at your background and what you've got access to, you've been a serial entrepreneur. You've been a successful serial entrepreneur. That needs to be front and center, right? The access and the network that you have is front and center. It all has to be shaped by the thesis of what you're going to do as a studio, how you're going to make these companies more successful. So that becomes that core story. Hey, we've got access to founders. We know a lot of their pain points. We've been there ourselves. We've got great experience in building companies for these types of customers. So we're really reducing the risk for the next product we build in the same space. And because you are there for founders, you probably have access to a lot of top tier talent just in that network. So if I want to look at network de-risking, I need to get great talent to build companies with, and I need to have access to follow-on capital. I think that's kind of baked into your products. So there's definitely pieces you can start pulling in to figure out how you would build and shape your studio.
Very cool. One or two more, and then I'll let you go. I know you've got lots of stuff to do. Of the venture studios that are funded, in other words, they raise capital, are they typically looking at venture capital firms, or would you maybe go after other LPs, family offices, even pensions, trusts, corporate VCs? Like, what are the capital sources for venture studios of those that choose to go down the funding?
Yeah. So most studios, their first raise is probably going to be high net worth and family offices as the main LPs. I've seen a couple studios start with corporate LPs. Institutional investors are really, really tough for fund one for a studio unless you have the right background and existing relationships. So this is an area where, because studios are such a new model, if you're going after an institutional LP, like, do they even know what a studio is yet? And now you have that huge education lift to get them aligned with this. Generally a path I would not suggest people go down. Leverage your existing network. So that's going to shape your raise strategy a lot and often cap how much you can actually raise. But yeah, the easiest ones to get to say yes are going to be individuals and family offices for the most part. If you can bring in some VCs, that's really going to make things a lot easier as well, because now you have that follow-on capital source you can point to and say, we've got a great relationship.
Yeah, that makes sense. I guess part of the pitch also to potential LPs, family offices, high net worth folks is, hey, we are going to back these startups. We're going to get a higher equity chunk of these companies because we're providing all these other services in addition, in addition to the capital. So we're going to own a bigger equity piece. We're going to have a more hands-on impact on a successful outcome, on the de-risking, all that stuff. I guess that's all probably baked into most venture studios' pitch to investors, probably. Yeah.
Oh, yeah.
Makes sense. All right, I'll let you go. But any other last thoughts we haven't covered? I know we just went all over the place with venture studios here, but any other either tips for founders, tips for people who are considering launching a venture studio, they're interested in that? What else you got? Anything?
If you're an entrepreneur looking to join a studio, it's very tough to find them. So that's one of the big hurdles I run into a lot. It's not often clear, is a studio interested in your idea? Do you need to have an established company or some proof around your product, or are they just looking for founders? So finding, if you're that entrepreneur and you want to partner with a studio, it's really, really tough today. There's it's manual search through maps and databases to find them. If you're looking to start a studio, the first thing I do is what's your path to launch this thing? Are you and your team really the right fit to do it? And pair those up. Well, the vast majority of folks that reach out to me, they want to go raise capital for a studio. 80% of the time I have to tell them, you're not in a position to raise capital.
They don't have anything happening, or they don't have the relevant background or unique advantage. What's the common?
It's a mix of that. It's tougher to raise for a studio than a venture fund. And the expectations are very similar. So if you don't have exits as an investor or an entrepreneur, if you don't have markups and have had a lot of enterprise value in creating companies as an entrepreneur or an investor, if you haven't increased sales or helped raise capital, then you don't have a great track record yet to go do this work. And so one way I like to explain this to folks is, if you're planning on building a venture fund, you can show people you can do the job by finding deals, selecting them, and putting them in front of LPs. You've just proved you can be a venture capitalist.
Yeah.
Great. How do you prove that you can be a good studio? I got to go find the deal, validate it, build the company, get some outside proof that this is going to work. I have to have the team, and I have to do this more than once. So, if I look at a lot of my clients, over 80% of them, when they close their first funding for the studio, they've already built at least one, and often number two is in the pipeline. So that first company that they've built has some outside validation. They've got cash coming in from customers. They've got investors that have put capital into that portfolio company. Proves that they can do it. And these are folks that have already built and sold companies themselves. But if you've done one, that's great. You're still not fully proving that you can do the studio model, because now this is not building one company, it's building many. So you got to show it. And that really raises the bar, makes this a studio so much more difficult to execute than even a venture fund. So be prepared for that journey. It is not a simple one at all. And it's okay if you can't raise capital. There are other approaches to launch. Go raise for the portfolio company, or go start a service business and use that as your pathway to building the studio infrastructure and the studio itself.
Excellent advice. I like that. That's actually really, really smart. I mean, it's not easy. Like what you just said, it's harder to raise for a venture studio than it probably is for a venture fund. It's actually very hard to raise for a venture fund. So, this is.
It is like,
yeah.
Startup is this hard. Venture fund is this hard. Studio is this hard. Right? it's easy to convince yourself that it's going to be easy to raise for a studio. Because if you're going down that road, you're bought into the model. You love it. Like, this makes sense, right? Well, you've triggered one of your own cognitive biases. You're bought in. You've got confirmation bias. Everybody's going to believe that this is going to work. No, investors see some of the best deals out there in the world, and they're going to compare you to those deals. You have to stack up well.
Very interesting. I won't keep you longer, although I could ask a dozen more questions. But if people want to learn more about you and what you do, where should we point them?
LinkedIn is probably one of the best places to see what I do. I post all the time on LinkedIn. I try to respond to comments as much as I can. Also have a website, but LinkedIn is where you're going to see me the most active.
And so people just search Matt Burris, Burriss, correct?
Yes. You'll find me on LinkedIn. It'll be Matthew rather than Matt. But I'm pretty easy to find.
Very cool. Well, thanks so much. This is really interesting. And maybe I'll get you back on in a year or so as the venture studio model has evolved even further, and we'll see what's going on at that point. How about that?
Sounds great, Nathan.
All right. Thank you, Matt. Over and out. Appreciate it.
Thanks. Have a great one.
Bye.